Hello and welcome to accounting. I'm going to be your guide through the myriad byways and thoroughfares of accounting. What is accounting? Accounting is the language of business. And when you learn any language, you learn the alphabet first. Now, what is the use of language in business? Well, it helps the various departments communicate with management, management communicate with each other, management communicating with the C-level, the CEO, the CFO communicating with other stakeholders and shareholders like vendors, the government, shareholders, and the markets. How the health of the business and how do we communicate that through accounting. And like I said, what is the first thing you learn when you learn a language? You always learn the alphabet. And here is our alphabet soup we're going to start with. A equals L plus OE, R minus E equals NI. That stands for assets equals liabilities plus owner's equity. Revenue minus expenses equals net income. This top formula is called the fundamental accounting equation. This bottom formula we call the income statement equation, or P&L, or profit and loss. So we're going to dive deeper into these two equations and learn some words associated with these letters. Let's first take a deeper look at the fundamental accounting equation. Assets are broken down to two main categories. We have current assets and fixed assets. Current assets are assets that have a term of a year or less, last less than a year, or are constantly changing. What are some examples of current assets? Well, the big one I always put in capital letters, cash, because cash is king. Remember that. All together, cash is king. No, say it together. Cash is king. Very good. The second one I call AR, for accounts receivable. Then we have inventory. We have prepay. And we have accruals. Cash, you already know. Remember, it's king. Accounts receivable are the bills for service or for products that you've sold that you didn't receive cash for. So if it's a non-cash sale, you're expecting to get paid in the future. You have you provided the service or you provided the product and you're waiting for the payment. That's a receivable. So you are waiting to receive it. It's receivable. Inventory is the finished products available for sale. Prepays. A prepay, I call a prepay. It would be something like your rent. Rent is due on the first of the month for which? Is it the previous month or is for the month that's coming? Always you pay rent for the month coming. So that is the rent for May 1st is for May, not for April. The same for insurance premium. When you pay your car insurance, you're paying for the period coming. So if you pay for May 1st, you pay 6 months, May, June, July, August, September, October. You paid through October, and then you'll have to pay again for another 6 months. If you pay month to month, you're paying for the future, not for the past. So that is a prepayment. And we will deal more with accruals later in this class. The second category we have is fixed assets. Contrary to current assets, which are a year or less or constantly changing, fixed assets are assets that last longer than a year. For instance, some examples would be land, property, plants, and not the green ones. This is the manufacturing plants, like the Rouge River plant that makes the F-150s for Ford. Equipment. Vehicles. None of these lists that I'm giving you of different accounts or different words are an exhaustive list. So there may be others. And we may come across others in class, but these are some general accounts. There is actually a third account or a third category for assets. It's called an intangible asset. The word tangible is a Greek word meaning something you can hold or touch. I can touch this whiteboard. I can touch these dry erase markers. You can touch your desk. You can touch your book, your textbook. We can touch a computer. We can touch, those are tangible assets, like property, vehicles. We could touch that. In, the prefix in means not in Greek. So intangible means not touchable or not something you can hold. So what are some intangible type of assets? Well, a big one in business is called software. You've probably used Microsoft Office or specifically Microsoft Word or Excel. That's software. In business, there are software packages that does the accounting, does logistics, may do credit investigation or financial analysis. These are all different softwares that businesses use. In the olden days, back in the 50s, we used to have punch cards where we punched holes in a card and then fed it into slots into the computer, and that's how we programmed it. We had tons and tons and stacks of cards. Then we went to the 5 1/4 inch disc, about maybe this big, that we stick in slots that uploaded programs into the computers. Then we had the 3 1/4 inch disc, about this big. You will recognize a 3 1/4 is if you look at a computer and you see the save button, the save icon still looks like those 3 1/4 inch discs. And we used to stick those into slots to program a computer. Then we used CDs, stuck CDs into slots and DVDs into slots to load programs. Today, we go on a website and we click a download link, which downloads through the internet the program directly in. We have nothing you actually touch anymore. We have downloadable links. And that's why software, but the software we download is so important that it has a greater value than the intangibleness of the download link that's got a value for the organization. So software is very big in business. Another example of an intangible would be trademarks. I'll put as TM, like Mickey Mouse or McDonald's, the golden arches of McDonald's. These are some trademarks. Those are just examples. Also, copyright. Patents. Or if you're from England, patent. But here in America, we call it patent. And warranties. Again, these are not to be considered or construed as an exhaustive list. We'll be dealing with some of these intangibles, again, also later in class. So again, this is an introduction to accounting, and I'm throwing out some words that we made from our alphabets. The next category we have is liabilities. Now, liabilities can be broken down into two categories. We have current liabilities and long-term liabilities. Much like current assets, current liabilities are anything that's owed to you that is a year or less in term or is constantly changing. Some examples would be AP for accounts payable, wage payable. I'll put as wage pay, or tax payable. Also short-term notes. In business and accounting and finance, we don't call them loans so much as we call them notes. So the word note and loan is interchangeable generally, and we're going to use them maybe interchangeably in this class. To be more specific, a note is a shorter term. A loan tends to be longer, but in this class we'll use the words interchangeably. Again, these are not exhaustive. We have other, surely other examples that we will run into. Another current liability we can think about is what's called unearned revenue. Unearned revenue is where you are going to provide a service, but that you were already paid for. So, for instance, and we will deal with it when we are not talking about our transactions, you're paid money today, but you're going to do the job next month. That's prepaid. You did not earn that money. And because it is unearned money, it is unearned revenue. So that's where the term and the account we call unearned revenue. We'll be dealing with that a little bit. Long-term liabilities, very similar to fixed assets. Long-term liabilities last more than a year, or have terms of longer than a year. Examples are mortgages, bonds, and other long-term notes. Owner's equity can be divided into two categories. One I call stock and RE. RE stands for retained earnings. I use the word stock in quotation marks. I'll put the quotation marks here because we are familiar with a portion of, we hear about the stock market in the news all the time. You hear about the bond market and business news. And so we hear about the Dow Jones and the stock market, Dow Jones Industrial Average, the S&P, the Russell 500, so many different indices of stocks. Now, stocks are a proportion of ownership. But when it comes to a smaller company or a sole proprietorship, we don't call it stock, we call it capital. Also, if you're in a small company or a sole proprietorship and the owner takes money out of the business, it's called a draw. So when the owner puts money into the business, it's called capital. When the owner takes money out, it's called a draw. And I'm going to put the word draw here, or drawing, and put parentheses around it. We also will be talking about common stock, preferred stock, and treasury stock. And I'm putting a parentheses around that too. I will explain much more of this much more later, why there are parentheses around those two. Because actually the capital, common stock, and preferred stock in the owner's equity section is added to when the owner puts money in, but when they take money out, it's a drawing, and a treasury is a unique type of stock transaction where the company buys its own stock back through the stock market at the market price, which effectively raises the market price is one reason for doing that. So it's a negative to the equity. And the final part is retained earnings, which is the plowback of net income over time. And I draw your attention to this point right here, which we'll talk in just a moment, net income. Recall just a moment ago that the R minus E equals NI, we had net income from there. So there's your connection between the fundamental accounting equation and the income statement equation, or the P&L equation, is this net income, tying it to the equity. Now we're coming to the second equation. R minus E equals NI, which stands for revenue minus expenses equals net income. Well, let's drill down on this one and learn some words from this spoon of alphabet soup. R stands for revenue. Revenue is sometimes called income, sometimes called sales, sometimes called net sales. It's known by different words based on the business that we're talking about. Revenue is an easy one that I use quite often because it's much of a catch-all. All income can be considered revenue. You can call it service revenue, you can do sales revenue, and you can use the word revenue for anything. All of the expenses I'm going to put in red, and we're going to drill down and look at some expenses. The very first expense that we look at is called cost of goods sold. Cost of goods sold is, as it says, the cost associated with the goods that we've sold, not the goods that we've produced, manufactured, acquired to be ready for sale. The goods available for sale is different than the goods that have been sold. What's available for sale is everything that's available, and that total, out of that total amount, we will sell a portion of that, and it's the cost involved with that. This could be the cost of your line people who are doing the production line, the supervisors of production, the utilities for the plants, the equipment in the plants. Those are things that would be considered part of cost of goods sold. This class, we won't deal too much with it, but in chapter 7 and 8, we will be dealing with it in a certain level. And when we subtract cost of goods sold from revenue, we get what's called gross profit. We're not done. We're not at the NI. We will get to NI, but we're at gross profit. Gross profit describes our core business. Our core business is to make F-150s, like Ford's core business is to make cars. The cost of the raw materials to make the cars. The cost in making the cars is here. The revenue is the sale of the cars. So what's left over after taking out just the cost is what's called gross profit, and that gives us our core profitability of just the core business. The next thing we subtract out is GS&A. GS&A stands for general services or sales and administrative costs. These are your back office cost, support costs to the core business. It would be the salary of the CEO. It's the salary of the accountants. It is the desks and chairs that are used in the cost of buying the desk and chairs used in the corporate headquarters. It's the copy machine and the paper used in the copy machines. It's the secretary's salary. That would be your general and administrative cost. Your services cost, maybe bank fees that are charged. That's a service. Calling for basic maintenance on a copy machine would be maybe a couple $100 or so. That would be a service expense. I also say sales because your marketing plans, and the cost of the salespeople, sales staff would also be part of that. When we subtract these costs out, so these are your staff costs, back office costs. These would be your line costs, the front line costs. You get what's called EBITDA. EBITDA. It could be pronounced EBITDA or EBITDA. I will tend to pronounce it EBITDA. That's the way I was taught, but I knew some people, and you might hear it on the news, especially Bloomberg, plug for Bloomberg, that when they're discussing business acquisitions, they say EBITDA. Depends on where you are, who you talk to, but EBITDA, EBITDA, it's spelled the same way. And it stands for earnings before interest, taxes, depreciation, and amortization. What is this depreciation and amortization? Well, depreciation and amortization is depreciation is an accounting function that writes down the life of a fixed asset. Fixed assets don't last forever. Land may be, but a car is typically considered only a 5-year useful life. And we depreciate by reducing that useful life relative to the cost on the books in the assets. So we depreciate that to reduce its book value. Amortization is very similar, but it deals more with an amortizing of a loan versus depreciating an asset, fixed asset. So long-term loans, long-term liabilities are amortized usually, and fixed assets are depreciated. The next thing we do is we take out our D&A. No, not DNA. This is not CSI. This is accounting class. It's the D and A. So we're going to subtract out the DNA, and what are we left with? EBIT, which stands for earnings before interest and taxes. The next thing we subtract out here is our interest. The interest is the amount of interest charged on our short-term notes, long-term notes, bonds, and we're left with, if we take out the I from EBIT, what we get? Or EBT, earnings before taxes. We subtract out our taxes, and this is the income taxes that we're talking about here, mostly, and we're left with net income. And now we're right back to where we started from. To understand how we write down or follow along on transactions, before we get to doing the transactions, I got to lay down some few ground rules here. First rule is that we want to think in T's. We want to think in a T account. A T account is a way an accountant uses to sketch out transactions before actually putting it into the general journal, the general ledger, into the financial statements. We don't want to put transactions into a financial statement or into a computer system, because in accounting, we can't just erase with the big eraser. We have to do reversing transactions to fix mistakes. So the best thing is to sketch before you make a mistake and then have it found out later. Now, mistakes can happen, but using a T account, we have an ability to sketch out the transactions without having to make the mistake in the first place. We can make our mistakes in our T's. Now, as I said, this is like a sketch, like an artist sketch. When an artist goes out into the field or goes out into the forest, he sees a subject, a tree, a line of trees, mountains, whatever. He doesn't take his palette of all his paint colors, because there's hundreds and hundreds of paint tubes, and he doesn't take his canvas, he doesn't take all his brushes, because there's a myriad of brushes as well. He doesn't take all that out to the field and then start painting immediately. He takes a pad, he takes a few pencils, which are his sketch pad and pencils, and he draws with his sketch pad. What that does for the artist is it sketches the subject that he wants to draw. It captures the light and shadows so that when it comes time to paint, he knows what colors to use for a shadow, what to use for the foreground, what to use the background, based on the sketch. Then he takes the sketch and he goes to the easel and starts painting all the way with his sketch on one side and the easel in his memory. He will remember what the colors are, but the sketch tells him exactly the relative size of the subject to other surrounding areas in the background, and so on and so forth. This is not necessarily a art class, but it's accounting, and accounting is an art. So in the T account is very similar. We use that to map out transactions. Now the T account always has a title, and that's the account we're dealing with for the transaction or part of the transaction. In this case, I'm going to use cash. We're going to use cash quite a bit. There's a lot of cash going in and out of an organization. On the T account, the left side is always the debit side, which is marked as a DB. That's DB. And the right side is always the credit side. So any debit to the cash account goes on the left, which would be the amount. Any credit to cash. Now, not all accounts will credit or debit. There's different ways to increase an account. And if we increase the accounts that increase with debits, I will list over here. If we increase the account with a credit, it'll be listed here. That's important to know. What accounts are increased with debits, which means that the left side is the increasing side, not the right side of the T. Well, assets, all assets are increased with debits. Expenses and the drawing account. All these and the subcategories, as I mentioned, cash, receivables, expenses like GS&A, cost of goods sold, those types of expenses, every one of them will be increased on the debit side. So any increase to the account will be written on the left. What accounts are increased with credits? Well, liabilities, capital, and when we get to it, the stock, the common stock and preferred stock. Treasury is increased with a debit, and the revenue accounts all increase with credits. Another thing you want to remember, the first thing you want to remember is that cash is, I just told you that. You know that earlier we talked about it. Cash is king. Yes. Number one, cash is king. Number two, never, ever, ever, never, ever, ever, never, ever debit revenue. You may have a debit or a credit to a liability or a capital, or you may have some credit to asset or a debit to asset. You will be those, but we will not ever be debiting revenue. Never, ever, ever. We're still not done with our ground rules. This is our syntax. When we come to a language, we start off learning the alphabet. Then we make words. Then we put those words into sentences, and those sentences will be what we're going to call transactions. We throw the transactions into T accounts, and then we summarize the T account in what's called a foot, which is the adding of both columns, and then the larger side is subtracting the smaller side, and then the balance of that foot of that T account is entered on the larger side. But before we go there, we still have to finish our syntax rules when it comes to transactions. So there are 5 rules, and you should have those along with the other cheat sheets that I've provided you. And on one of the pages is these 5 rules when it comes to transactions. When you make a sentence is, I went home. I went home. In English, we have a subject, verb, object, or sometimes just subject, verb, is the basis of a sentence. So subject, verb, 2 pieces, sometimes 3. I went home. I is the subject, went is the verb, home is the object. You can't say home went I. That's not correct. It's correct in that it's the correct tenses, but the order is wrong. The syntax is wrong. You can't say went home I, or went I home. We're not Yoda, so we speak in subject, verb, object in English. So there's rules that we know, and I have rules in the language of accounting. So the first rule that we're going to talk about is number 1, read. Read the transaction. Understand what is being said and what was happening there. Number two is which accounts. Which accounts are being affected by that transaction? Is it cash? Is it receivable? Accounts receivable? Is it a capital? Is it notes payable? Is it short-term notes payable, long-term notes payable, unearned revenue? Which accounts are being affected in that transaction? Now, because of the double entry accounting that we talk about in modern times, we currently, for the last 600 plus years, we've been using the double accounting method. That means that for every transaction, there's at least 2 accounts that are being affected. Sometimes 3, 4, even 5 or more, but at least 2. So in this class, we'll be dealing with at least 2, sometimes 3 or 4, but at least 2. So which accounts are we dealing with? Number 3, which accounts are increasing? Which accounts are decreasing? Which accounts are increasing? Which accounts are decreasing? Now, sometimes we have accounts both are increasing, sometimes both are decreasing. Sometimes if we have 2 accounts, one is increasing, one's decreasing. The point is you need to know which one's increasing and decreasing, because then you can help, and that will tell us where we're going to go with number 4, which is which account is being debited and which account is being credited. You could have 2 debits, you could have 2 credits, or one of each. But you need to know which one's which. And it is also based on which is increasing and which is decreasing. And the last step is record the transaction. Now that we've gone through the rules, we've talked about syntax, we talked about the alphabet, and we put the alphabet and made words. These words we made into, we made the categories and the counts. We found the rules on what we need, all the steps we need to do. We understood the T accounts for the syntax. Now let's do some transactions. So we're going to take us out of our textbook, which is the one with the color cover, Finance Accounting Principles. Turn to page 43. And we're going to do these transactions from page 43. So the first transaction we have is the owner deposited $30,000 cash into the new business account. So remember, the steps are read the transaction. We just read it. Step 2, which accounts are being affected? Well, the owner put money into the account. If the owner puts money into a business, that's the capital account. So one of the accounts we have is capital. But we always have at least 2 accounts, double, double. So what's the other account? Well, the owner put $30,000 in cash. So we have capital, which is part of owner's equity, and we have cash, which is an asset. Which accounts are increasing, which accounts are decreasing? Well, you notice that there's nothing on the board right now. Therefore, we are increasing the accounts on the board for this first transaction. So both accounts must be increasing because the owner put money into the business, so the account capital increases, and he put cash, which means the cash account is increasing. So let's put those up here right now. We have a T account that we're putting in for cash, and we're going to put a T account over here for capital. Both accounts are increasing. Which is a debit and which is a credit? Refer back to my list of which accounts are increasing with debits and which accounts are increasing with credits. And we find that assets are increased with debits, and debit is the left side of the T account, so we put 30,000 on the left side. And capital is increased with a credit, so we put 30,000 on the right side. And we've recorded the transaction into T's. The next account. The next transaction is Ace Bookkeepers borrowed $10,000 from the bank. Step 2. Which accounts are we talking about? Well, when you borrow money, do you get stuffed animals? No, you get cash. So we have another, we're dealing with cash. What else? Well, we borrow money, that is a debt we owe, or a loan. And when we said no, when we talked about a loan, we said that we use the word note. So we have a note. Do we have to pay it today? No, it is not paid, it's payable. So we call it a note payable. And that would be a liability. So we have another account here we're going to create, which I'm going to put NP for note payable. Now, which accounts are increasing and which account is decreasing? Well, we received cash. Ace Bookkeeper received cash. That means cash is increasing. And we owe now, so that means our notes payable is increasing. So both are increasing. Which is a debit and which is a credit? Well, cash, we know that when we increase cash, it's a debit. So we're going to put 10,000 over here on the left in the debits. And remember again, back to which accounts are increased with credits and which are increased with debits. Liabilities are increased with credits. So we're going to put the 10,000 over here. Always, always, always remember that whatever we do on the left side of this equal sign must equal what we do on the right side of the equal sign, because this must balance. And so far, we have 40,000 over here, 10 plus 30, 40,000. Next. Ace Bookkeepers bought $8,000 worth of furniture with cash. Which accounts are being affected? Well, cash is being affected, so we know we have a cash. What's the other account? Furniture. Furniture is one that we have not talked about yet, but it is a fixed asset, means it's an asset. So we have another new account we're going to put here under the asset side. We'll call it furniture. Which account is increasing and which account is decreasing? Well, we bought furniture, which means we increased the furniture, but we decreased cash because we spent cash. So we have 8,000 credit to cash because we increase with debits, we decrease with credits, 8,000 And we are increasing our furniture, that's 8,000. Quick check, are we still in balance? Well, we have a credit of 8,000, a debit of 8,000. That kind of cancels it out. So we have 40,000 over here, and we have 40,000 over here. We're still in balance. The next transaction we have is a customer paid $2,000 cash for bookkeeping services to be provided next month. So, what two accounts are being affected there? Well, they paid cash, so we know cash is affected. But it's for services we are going to provide, but we haven't done it yet. Since we have not earned the money, it is unearned money. And remember, unearned revenue is a liability. So we're going to create another account here called unearned revenue. Which accounts are increasing, which accounts are decreasing? Well, we received cash, so cash is increasing, and we have now received unearned revenue. We will show that it's earned later. So we have now both these accounts are increasing. Which accounts are going to be debited, which is credited? Well, an increase to cash, again, is always a debit. And we're increasing a liability. So there we go. Number 5. Ace Bookkeeper provided services to a customer and received $15,000 in cash. So they provided services. Therefore, it was earned. They did the job. So it's not unearned revenue, it's earned revenue. We don't say earned revenue, we just say revenue. So we have yet another one, revenue account. And cash. Which accounts are increasing, which accounts are decreasing? Revenue is increasing because we received $15,000 for services we did do. And it was in cash, so cash is increasing. When we increase a revenue, it's a credit. So we're crediting $15,000 over here, and we're going to debit $15,000 because cash is increasing. Number 6, Ace Bookkeeper provided services for $4,000 on account. On account means that they did not pay for it today, they will pay for it. And we provided services. So if we provided services for $4,000, that's revenue again. So revenue is increasing, but it wasn't in cash. So cash is not affected. We are going to have a new account called accounts receivable. So I'm going to put that down here, AR, and that for 4,000. Accounts receivable is an asset. It's a current asset, and it's increasing, so we are putting it as a debit over here. The next one is Ace Bookkeeper paid $6,000 cash for a 1-year insurance policy, which starts at the first of the next month. So what two accounts are being affected? Well, we paid $6,000 in cash, So cash is affected. What else? Insurance. Well, we didn't pay for something that already happened. We're paying for 1-year policy. Remember that we pay for something that hasn't happened yet. It's a prepay. So we actually call it prepay insurance. Which account's increasing and which account's decreasing? Well, cash is leaving, so cash is decreasing, but we bought a policy. So the insurance policy account is increasing. So by 6,000, so we're crediting 6,000 in cash because it's leaving, and we're debiting 6,000 from our prepaid insurance. The next transaction is actually 3 separate transactions, 9, 10, and 8, 9, and 10. Ace Bookkeeper paid rent for the month. They paid $1,100 for rent, $6,000 for salaries, and $200 in cash for interest. All 3 of those are expenses. So we're going to put it over here in the expense side. We have rent, expense, we have salaries expense, and we have interest expense. Rent and expenses are increased, so we're increasing our expenses because we're spending money, but we're paying it in cash, so we're decreasing cash. When we increase an expense, it's a debit. So we have 1,100 here. We have 6,000 here. And we have 200 here. All 3 of these are going to be credits on the cash side. 1,100, 6,000, and 200. The next transaction, Ace Bookkeeper receives a telephone bill for $300, which will be paid later. So it will be paid, just like our note here, it will be paid. So if we're owe something we're going to pay, that's a payable. In fact, it's going to be accounts payable. And we're going to create a telephone bill account over here. I'm going to put it as TELE for telephone. And that's for $300. So we debit $300 from the expense because we're increasing expense, and we're increasing accounts payable, and increase to liability is a credit. The next one is we paid travel expense with a credit card, which will be paid next month. That's also, we're going to pay it, but we haven't paid it yet. So it is a payable. It is payable to the credit card company, but we haven't paid it. So we have another account here. We're going to call it travel as an expense, and we're going to add it over here to accounts payable in the amount of $2,000. So we're going to debit travel for $2,000 and credit $2,000 in accounts payable. More precisely, and in this case we'll leave it this way, but more precisely this would be a credit card payable, not accounts payable. But again, for simplicity's sake, we'll keep it at accounts payable. Number 13, Ace Bookkeeper repaid $3,000 on the note payable. What 2 accounts are being affected? Well, I just said note payable, so that's being affected. What else? How are we paying down the note? We're paying it with cash because cash is king. I told you this is going to keep coming up. Cash is king. So, which accounts are increasing and which accounts are decreasing? Well, if we're paying down the note, that means we're decreasing this amount. We're paying amount now, so we owe less later. So we are actually going to pay $3,000. If we're reducing a liability, we increase liabilities with a credit, therefore we reduce a liability with a debit. So that's $3,000 over here on the left. And because we are decreasing cash, cash decreases with credit. So that's $3,000 over here on the credit side. The next transaction is the owner withdrew money for his own personal use. When the owner takes money out, it affects the equity section, not capital, so we don't debit capital. What we do is we have that drawing account under the equity section. So I'm going to put draw here. In the amount of $2,000. So we know that drawing is one of those accounts that increases with a debit because we're increasing the amount that we drew. Before this, he didn't have anything there, so he's drawing $2,000. But he draws it in what? Cash. So it's a credit to cash because cash is going down. Next, a customer paid $500 cash for the amount owing for services provided earlier in the month. So, customer is paying for what they owed us. They owe us here in the receivable, and they paid $500 for it. So, they gave us cash, so cash is increasing, but they owe us less, AR is decreasing. So 500 is a credit to AR and a debit to cash. Extend that a little bit so you can see that all this is happening in the same account. And lastly, Ace Bookkeeper pays the telephone bill. This telephone bill right here that we put in, and where did that go? It actually went to accounts payable. So we're now paying it. If we're going to pay it, we have to pay it in cash. So AP is being affected and cash is being affected. We're going to debit because we're reducing this by $300. And we're decreasing cash by $300. Now, we need to make sure that both sides are still in balance. We only took a couple of spot checks, but we haven't spot checked in quite a long time. And all we have are a bunch of numbers on the board in T's. This is very confusing. What do? Well, again, when it comes to T accounts, what we do is we take both sides of the column, both columns separately, add the columns from both, and the total, the smaller total is subtracted from the larger total, and that amount is left on the bottom of that column. For instance, when we look at AP, we have 300 on the left, we have 2,300 on the right. 2,300 minus 300 leaves 2,000. The 2,000's on the credit side, so this one ends up with a credit balance of 2,000. The drawing, easy, 2,000. Capital, easy, 30,000. Revenue, there's no credit, there's no debit because we never, ever, ever, never, ever, ever, never, ever, ever debit revenue. So 15 plus 4, that's 19,000. Rent, easy, 1,100. Salary, easy, 6,000. Interest is 200. Travel is 2,000. Telephone is 300. Our unearned revenue is easy at 2,000. Our notes payable, we have 3,000 on the left, 10,000 on the right. The total on the right is more than the left, so 10,000 minus 3,000 gives us 7,000. Prepaid insurance is easy at 6,000 debit. AR, we have 4,000 in the debit column, we have 500 on the right column, the credit column. 4,000 minus 500 gives us 3,500. Debit. Furniture is easy, 8,000. Now the cash is going to take a little bit of time. I'm going to pause the video for a moment, recalculate it, and come back to you. So, I've already figured out the foot, which is the total of the cash account, which is 30,900. And right here, what I did was I took all the feet, the balances of each of these T accounts, and listed it right here and added them together because these are all debits, the same debit left side. So 30,900 plus 8,000 plus 35,000 plus 6,000 equals 58,400. Check on your calculators to make sure. On the right side of the equation, I took all the credits balances, 7,000, 2,000, 2,000, 30,000, 7,230, added those together and subtract, and I'm sorry, there's the 19,000 right here too. This is a credit balance. And subtracted out all the debit balances. The 2,000, 1,100, 6,200, 2,300. That's the 2,000 here, 11,6,2, 2,300. Add and subtract and you get 58,400. What's the balance on the left side? 58,400. What's the balance on the right side? 58,400. Are we in balance? The question is, are we in balance? The answer is yes, and then we go boom. So, are we in balance? Yes. Boom! This ends chapters 1 and 2. The next video, we will start up with chapters 3.